All right, what's going on, fellas?
How you doing, Will?
What's up, guys?
Doing good. It's a
Hey,
pleasure.
Justin.
Thank you for taking the time, Kenny. Appreciate you tapping in. And Justin, also, I want to shout you out and say thank you for taking the time. We're gonna go ahead and jump right into it if that's cool.
Yes,
Yeah,
sir.
All right. So, real quick, for those of you who may or may not know, not sure when you'll come across this video, but the purpose of this video is to introduce you all to this financial vehicle that we are about to talk about here in a minute. But before we do that, I wanted to go ahead and just give a high level overview on who we are as Cythority and the brand vision and movement. So Cythority is a cybersecurity managed service provider. We service clients, small, medium-sized businesses, and provide cybersecurity monitoring and operations. And so, in addition to that, we have a stellar world-class cybersecurity training program, which my good friend Justin here had the opportunity to participate in. And so, really, what we're looking to accomplish here is give folks an opportunity, right? Give folks an opportunity to get world-class cybersecurity training, hands-on, no fluff, no gimmicks, straight hands-on experience using real tools trained by real people to get real results. And so Justin here had that opportunity. He took advantage of it. And we want to go ahead and scale this so that more people who are looking to break into cybersecurity and secure their future also have an opportunity to secure their freedom and use cybersecurity as a vehicle. And so real quick, Justin, I just want to say thank you for taking the time to be here. If you could really quick, just kind of tell the audience and folks who may come across this video just who you are and just a quick high level overview on just your story in the program and what we're doing next.
got you. Uh, Justin Bailey, 32. I have about 13 years in physical security professional. Across that time, I've worked for large companies like Barclays Center, Madison Square Garden, Meta, and most recently, Snapchat. Um, I had a little hiccup throughout this beautiful career of mine, where right between the jobs in Meta and Snapchat, I kind of was jobless, and that's where I started to panic a little bit. Will's been a good friend of mine for a long time and developing this program for some years. He did originally help me get into the Meta job, so when I had my little issues at MSG, I originally came straight back to him. Came straight back to him. He put me into the program. This may have been around February of this year. I was in the program for about 3 months and then I got the job at Snap. Title, the idea of it was much better than what I was doing, even though the pay wasn't totally where I was trying to get. Kept going at it with this program, started doing a little bit more than just the program, learning the job promotion part of it and the selling part of it and how to get your information out there. And now we're talking about making 3 times the amount I was making at Snapchat. In this company called CoreWeave, I got my first tech job ever. Um, it's a little it's a lot to take in. I'm trying to keep it brief, but this has been a total wake up call to me because it's it's just been what I've been doing, but consistency and a better guidance to keep myself on the right path. So thank you again, Will. Um, Going up in income double would have been amazing. Triple is kind of out of this world. I'm still trying to take that in.
Yeah, I remember when we were doing the salary negotiation, Justin had a call with his manager, and he was essentially a call to negotiate his salary. And he was like, "Look, I'm going for the max. I'm going for the max." And I think the max was like 88 or just under
Yeah.
90K. And I was like, "Listen, you're gonna go get the max then. That's just it. Like, go get the max then. That's what you're gonna get then." And he was like, "All right, yeah." So I finally convinced him to to run game how he was supposed to. And he comes back.
Yes, sir.
I remember the have a screenshot of the FaceTime call. I put him on blast a little bit, right? I had a screenshot of the FaceTime call of him hysterical because not only did he just get the max, he got double the max. Like, which I was like even kind of fell out my chair about because I was like, man, we want to get the max and he got literally double. I think you came in at around 160 total comp with your total
Yes,
package.
sir.
So to go from being jobless 5 months ago to now making well into a six-figure handsome salary, right? That's why we're on this call. Because a lot of people, if they're lucky enough to get to the level that you're now on, which is going to be your floor, I believe you start tomorrow, right? In your new role. That's exciting.
Yeah.
And so what we're doing, right, is we're concatenating what we call cybersecurity, which is the vehicle to generate the income, which you accomplished, and we're concatenating it with financial literacy. And when those two terms meet, right, and they marry, they create a term we're basically branding as cyber literacy. And so that's where now Kenny comes into play, where most people, when they're giving financial advice, you watch a lot of podcasts or you're on social media, they're like, hey, this isn't financial advice, buy our XRP, but it's not financial advice, go speak to a licensed, financial advisor. Well, we have one here today, folks. And he's a really good friend of mine. He's a great brother. He has helped me tremendously with respect to setting up my financial vehicle, my foundation, putting the nails in the wood and making sure that things are stable for my family. I'm a husband, have a wife and 2 children, and so for me it was really a matter of making sure that my financial foundation was set up the right way so that I can not only accumulate wealth but also keep wealth, and I can also benefit from not just, or my family could benefit from not just the death benefit after I'm no longer here, but also understand the living benefits and the structures of this really, really unique vehicle that I knew nothing about until I came across this gentleman. So without further ado, everyone, I want to just introduce my good friend and brother, Kenny Charles. Kenny, it's your world, man.
Thank
Thank
you
you.
for the kind words and introduction. I appreciate that highly. As well as saying, I'm a licensed financial advisor, or fiduciary, if you guys have heard that term on commercials and such. And what it means exactly is you're working with a professional who's licensed. Not that we wouldn't do it otherwise most of the time, but somebody who's licensed and supposed to put your best interest, before their own interest, essentially. So you want to make sure that anybody you're working with in a professional sense, especially with their money, but as it applies to like lawyers, accountants, that they're always, operating in that fashion. Um, so myself, I'm a financial advisor of the company or team that I work with is Equinox Financial Partners. We're based out of New York, Melville. What we do, help people make informed financial decisions, both on the investment side, managing money, picking stocks, so on and so forth, retirement, big picture things, and then also the insurance aspect of things. So life insurance, disability insurance, and for older individuals and folks, we talk about like long-term care planning, planning for like life's later stages and like potential medical expenses they may encounter there. So as Will was saying, one of the main vehicles that we were hyper focusing on was like cash value life insurance, where it doubles. It's two focuses. Number one, what's most important is securing the death benefit, especially if you have people that are dependent on your income. That's the main reason why you want to purchase the life insurance. So main thing, you get a death benefit when you buy the life insurance. It's usually payable tax free to whoever you name as your beneficiaries. But what permanent life insurance does, it allows you to have both that death benefit and then cash value. And if I can share my screen, well, I'll just go through like the basic types of insurance contracts so you guys get an idea.
Yep.
You guys let me know if it switched over.
Yep, we got you.
Let me just make this a little bigger so I can see.
Yep.
It's still sharing?
Yeah.
All right, good. So it should say the 5 different types of life insurance. So number one is the most basic and simple form. It's term life insurance, where you're only securing that death benefit. What I was saying before, it's tax-free life insurance benefit. You're locking that in, and then you have a fixed premium that you're paying for that too. It works like any type of renter's policy, or even renting an apartment. While you have it, you're getting the benefits of it. With term insurance, it's just that death benefit. But after it's up, you don't really have many options. And that one, although it's the most cost effective, it's the most, cheapest type of life insurance you're able to buy, you're not building any equity or, life insurance cash value. 2 through 5 are all the different types of permanent policies. No one is better than the other. It's just a difference of how the cash value grows or how it's invested. And then in turn, depending upon who's the best candidate for it, it's really upon like what stage they are in life. Somebody who's younger, a lot more time to invest, I would steer them towards like a investment or market linked insurance policy, index universal life, variable universal life. Somebody who's more on the conservative side, we would likely be talking about a whole life insurance policy, or like a universal, guaranteed universal life policy. Whole life and guaranteed universal life, or number 3, these are going on like more fixed terms, where you're not really, the cash value is not affected by the stock market. 4 and 5 are market linked policies, where It's either an index where you're investing into S&P, which is the 500 biggest companies in the US market, NASDAQ, another, domestic or US index that tracks likely or mostly tech stocks, excludes financial companies. There's the Dow, which is like the 30 biggest companies and so on. But, all in all, what the index policy is, it's a direct investment in those indexes. Most of them give you a floor, so you won't lose money. And then while you're investing in those indexes, there's also a cap. So there's like 1 year periods or 3 year periods where they're evaluating those indexes. And for example, let's say you have a 0% floor, so you're not going to lose money while you're invested over that time interval. But on the upside, they'll give you a cap rate on how much your money is going to grow. So say, for example, over the 3 years, the most upside you have on that S&P is 15%, right? So in any 1 year that the max you're able to earn is 5%. So not that you're not, keeping up with inflation, but you are investing in the index. It's just that you're capped and you're not going to lose money. Number 5 is the more aggressive type, because the variable, you're investing in what we call sub accounts, but for all intents and purposes, it's very similar to like a mutual fund. So a mutual fund, it's not an index investment, although you can buy indexed mutual funds. But unlike an index investment, mutual funds will fluctuate directly with the market. So you want to have a floor, you want to have a cap. When the market's doing great, you'll get that full return. And then when the market's doing poorly, of course, you're going to see that reflecting your policy's cash value. The mutual funds, they, depending upon which company you choose, most of them, they are diversified, so you can have, S&P index the same way you would in your index policy, but then they'll also give you like technology mutual funds or like bond funds, or more specific stuff like healthcare, semiconductor, so on and so forth. So you can get creative with like how your cash value is invested in number 5, the variable policy, which is good because it does give you, the opportunity to aggressively grow that. So when we're talking about, cash value potential, 5 is going to give you the most. 2 and 3 are going to be more on the conservative side because you're growing more in like fixed rates, or like a non-guaranteed dividend from an insurance company. So I'll stop there. I know, Will, you're the sharpest as they come to, when it comes to this. Justin, if you have any questions, I'll just stop now and answer them for you.
So
I was
no, go ahead, Jess.
No, go ahead. I was gonna say I was getting a little confused when you was talking about 4 just because of the breakdown, and I was unsure of, okay, well, you kept saying we don't lose, but then I kept hearing the market value, and then when you broke down 5, I think I fully understood the difference between those two. So I'm gonna let y'all keep talking so I can learn more, but
Yeah.
I feel like you've made it pretty clear
hmm
where I have a good understanding of the basis right now, where
Yeah.
I'm comfortable with saying, okay, 5 is sounding like something I'm more intrigued with, but let me
Yeah.
hear more. I'm sorry, keep going.
No, and I'll pause there because that's a great question. Number 4, unless it's something that you've done before, you're not going to be truly familiar with it. 5, it's going to resemble, it's an insurance policy, yes, but the way the cash value is invested, because it's sub accounts or mutual funds, it's going to resemble like a 401k or like a brokerage account in a sense where you can
Okay.
just pick exactly what those funds are, and then it's easier to track in a sense of this is where my cash value is, and I know exactly like what sector or index the money's invested into. Number 4, so again, it is a direct investment into the index, but what it's going to do is, let's say, this is your floor of 0. Draw my 0% here. Oop, this is not being responsive with me. So this is 0%. And let's say they give you a cap rate of like 10. And then all the way down here is like -30, for example. So let's say in year 1, your cash value grows, or the market, and this is the S&P index, it returns 30%. Your cash value, because you have a 10% cap rate, I should have the percentage there, it's only going to grow by this 10%. All the excess here, it's kept by the insurance company, goes to fees. That's kind of like the opportunity cost that you're giving up for this kind of safety, this 0% floor, because you won't lose money,
Gotcha.
right? But let's say, the market's not as good. In year 1, the market returns -20. Even though the market's -20, because you have a 0% floor, let's say your cash value is at 1,000, it's going to stay at 1,000. You're not going to see any losses because you had that 0% floor. So that's the trade-offs. We know the market, on average it'll do about 10%, but there's going to be years where it'll do, 20, sometimes in excess of 30, but you won't get
Mhm.
to bear or you won't get to reap that full return because of how this investment's structured. But for
Gotcha.
that, sort of opportunity cost of the excess returns when the market's doing great, you're getting the benefit of the 0% floor. So you're not going to lose money, but when the market's very, very up or returns extraordinarily well, we're not going to get to keep that full return.
Copy that. No, that's understood. Thank you.
No, of course.
And
And excuse my drawing. I wish that was, it was a little
Yeah, the
easier, but
artwork was on point. I understood. I understood.
all right, cool.
Picasso. I want to just say this because I think it's important. Most people, they're not familiar with life insurance, right? Most people probably don't have life insurance, whether it's term or whole life, let alone a index universal life or variable universal life. Um, just to kind of like overview, right? So you have that term life insurance, which is for a specific term, fixed period, right?
Hmm.
With a death benefit, no living benefits though. So if you have that, and let's say you pass away within that term, then your beneficiary gets, the essentially death benefit for what you purchased. Whole life
Exactly.
essentially is whole life, so it's not for a particular term. You got a fixed premium, and then there's no living benefits essentially, but you just get that death benefit at the end, so to speak, right?
Whole life can have living benefits because there is cash value. So
Got it.
like any of the other permanent policies, you technically can get money or borrow money from a whole life policy too.
Roger that. Okay, so then there's that.
Hmm.
But these other vehicles, they're very unique in the sense that they have the death benefit, but they
Hmm.
also serve as like a brokerage account, right? We talk about
Exactly.
life insurance is one thing, but most people also don't even have a brokerage account, right? They don't invest. And
Yeah.
so these policies, number 4 and 5, and specifically want to highlight 5 because I think it's the most versatile and um, incredible when if depending everyone's risk tolerance is slightly different, but
Exactly.
with respect to the variable universal life insurance policy, you get the death benefit, right, as you would all the other policies, but you also now have you're purchasing and buying into a vehicle that has living benefits and where your money is building and accumulating cash value in the stock market that you can specify with
Hmm.
unlimited upside. And if I'm not mistaken, Kenny, keep me honest here, but you can also hedge your investment and essentially hedge your downside as well. There's ways where
Very
you can
much so.
also do that. So the
Yeah.
IUL is a great vehicle, and I actually have both.
Hmm.
My children have policies, my wife, and I have both IUL and VUL. Once I learned what a VUL was, I was kind of like, wow, well, I kind of wish I did the VUL from the beginning, but I also have a higher risk tolerance and threshold than most people. Plus, I'm a little younger, so like I have some room to be risky. But the
Yeah.
index universal life or IUL has the investment or brokerage like component to it, but you're limited on top, right? You're limited with that ceiling over your head, but you also have the floor that's never going to get cut from underneath you. So there's benefits to both. Now the VUL is incredible because you don't have any of that cap on the upside, but you can also, if you structure it correctly, can hedge on the downside. And Kenny, I want you to talk a little bit about that because I know when a lot of times people hear, oh man, that there's, I can, it fluctuates, they get a little
Hmm.
hesitant. But talk about the risk mitigation in the VUL. And I think also maybe a better place to start before you do that is you talked about how you can invest in mutual funds. Not everyone knows what a mutual fund is, but from my experience, it's kind of like you can think of it as like a basket of stocks, essentially, almost like an ETF. But correct me if I'm wrong. What is a mutual fund?
No, that you said it perfectly. That's really the best way to think about it. And I'll put it relative. So if a stock is going to like a mom and pop shop or going to like a specialty store, like think like a runner shop, that's on the corner of in your neighborhood as opposed to like a Foot Locker that's in a mall. That corner store, let's think about it as like a stock company. It's one single company. We know if we go there, exactly what we're going to get, or if we invest into that company, exactly how that company is going to act. A mutual fund or an ETF, they're kind of interchangeable in this example because they both function like a mall. In the sense of you can go to a mall, go to the Foot Locker, but then also if you want to do something else, shop for cologne, there's fragrance stores there. Or if you want to go to, Saks Fifth, there's also the opportunity to go there as well. So in this ETF or this mutual fund, you can go to the mall and there'll be a ton of different stock companies that are in this one ETF or in this one mutual fund. There's ETFs that focus on indexes. So in the S&P 500 ETF is going to compose all the companies that's in the S&P 500, or like a technology ETF. It may have some companies that are in the S&P, but it's going to hyper focus on companies that are in the technology space. So it won't include, like a Costco, like a Target. Those are more like consumer driven companies.
I appreciate you breaking that down. So, I think it's a little easier to understand once you understand like the underlying right vehicle. It's like you can invest in specific companies, like in the stock market, you invest in Apple and Microsoft, but within an ETF or mutual fund, which is the underlying right vehicle you're investing in when you purchase, like say a VUL, you can buy mutual funds, which are in layman's terms a basket of stocks, and
Exactly.
you can specify them on industry. So Kenny, I know when you and I spoke months ago, when we set up my VUL, I wanted to be more on the aggressive side and growth side. So
Hmm.
I want to specify my basket of stocks in AI and tech. And so you
Hmm.
can do that just like you could in the stock market. So that's just some of the
Exactly.
really cool things when it comes to VUL. But talk a little bit about the hedging part, because that I think is
Yeah.
really important.
Yeah. And I don't want to sound biased, but like to your point before, we're younger, so I do like lean towards the VWell when we're talking with people in our demographic to that point, because it's kind of like all encompassing in the sense of we can be in the mutual funds or either specializing in things. We want to be super aggressive, be in technology, stay in the S&P and Nasdaq. We have the ability to do that. When we see turbulent markets or we want to preserve the policy's cash value, there's tons of different stuff there that we're able to do. There's VULs that give you the ability, like even though you have a VUL, you can shift your cash value like in an investment account that'll be more like an IUL. So even though you started out with the VUL, while you have this policy, if you want to preserve some of your cash value, the market's not doing as well, you don't have positive prospects for the market over this period of time, you have the ability to shift your policy's cash value from these mutual funds into the index account. So it's going to give you that floor and you'll have that cap, for the meantime. So you're preserving your cash value. When you want to switch it, when the opportunity presents itself to move back into the mutual funds, you have that ability to do so as well in the variable policy. And not all companies will do this, but there are all-encompassing VULs that'll both have the mutual fund, the ability to invest in the mutual funds, and the ability to invest in the index options. That's number one. Number two, what you can also do, to the point before about how these are very diversified, there's going to be a lot more investment options than there are in like the indexes. There's only so many indexes that the company is going to provide you in the IUL. But within the VUL, there's going to be index investment options. There'll be actively managed mutual fund options. There'll be bond and there'll be fixed mutual fund options. So we can move into like a bond fund, either an international bond fund, a domestic government bond fund, a corporate bond fund. Bonds, they differ from stocks because they're generally safer. Instead of equity in a company, bond is a debt instrument. So, it's going to pay you a fixed coupon. It's not going to perform as well as the stock market does over time, but with bonds, right now, we've been earning generally good yields. The Fed is dropping interest rates, but for all intents and purposes, it's been for like around 4 to 5% over the past 3 years or so. It's not a terrible place to put money, but to the point before, that's also a place where you can shift your cash value. If you're concerned, you could move it from the equity or the stock mutual funds into those bond funds and be earning more of like a fixed rate on your cash value. And then same thing, when you want to shift it, you can move it back into the stock market. Um, so two things there, shifting it into the indexes, shifting it into the bond fund options. And then also, there are guarantees that some of these VULs will give you as well. So most times at a baseline, a company will guarantee these policies at a minimum for the first 20 years. So regardless of how the stock market does, even if your cash value is poorly performing, it's still going to be guaranteed at a minimum for the first 20 years. And then sometimes, other companies or some companies will give you like a more robust guaranteed option. So, we do want the cash value to grow, but at a minimum, you won't lose your insurance with these guaranteed protection on your death benefit. So one and two are most important. We do have good prospects if we're going to be putting your money into the market. It is going to grow. And then three is kind of like that safety net, that oops, if we have another 2008, that's for even longer extended period of time where the market's not doing well, doomsday, then the number three is going to be important in terms of having that guaranteed coverage.
That sounds good. Justin, any questions or anything?
Just right now, what I'm catching the main differences is you can both allow you to increase and grow your money. One is just more slow and steady, more safe. The other one's a little bit more fast, not as unsafe, but more risky. You just have to learn how to understand it better and do certain things so you can, I guess, minimize those risks.
Yeah.
I'm I'm good so far. I'm staying up to par with you guys.
Perfect.
I had to type in a couple of words you were saying, like when you first said hedging, but I'm up to par.
Yeah.
I understood what it means.
All right,
Awesome.
cool. So
So
what
Kate,
I'll
you
go
have,
ahead, Will.
I'm sure you have another illustration or something to go through, like where we can get like a real world example of, let's just say, hey, this is how much money, you're making this amount of much money, you're 32 or you're 30 years, whatever illustration you have. I'm sure you
Yeah,
do. If not, we can go through an example just so he can understand real numbers and actually how this actually works. Like,
of
how do you
course.
leverage it? We hear the term infinite banking, right?
hmm
What does that even mean? How does someone do that? What does it look like over the course of the next 20 years if Justin purchases a policy for himself or his wife or his kids? Like,
hmm
I think that would be helpful and beneficial.
Yeah.
And you had something, Just, or?
Yeah.
That
Justin, we're gonna say.
that's exactly what I was gonna say. I was gonna say, use me as an example. Let me know.
Yeah.
That's why we're here.
And two, like, caveats I want to throw in there, like about infinite banking, and then two, just like general, financial planning, so to speak. So infinite banking, yes, definitely real world concept. It does work in practice. You know, Before our time, the financial literacy knowledge, it wasn't as robust as it is now. We have tons of social media platforms where they're talking about these things all the time, so that's great. My only gripe with it is that we have to be careful. Number one, the person that you're working with, you have to have a level of trust in them. But you as a consumer, you have to know what it is you're purchasing too, and understand that while you're at first buying the concept, this is a financial vehicle. It's a tool that you're going to have to maintain over time. So just like you do with your personal banking accounts, more so your brokerage accounts, your 401k investment accounts. It's nothing that you're gonna stick in the drawer and forget about, for years to come. This is something that you have to maintain on an annual basis. There's going to be reporting. You'll get at a minimum an annual statement. So you have to be careful and wary of what's going on with your investment because it's a long-term plan. You want to make sure that everything is functioning as the plan was originally intended. So yes, infinite banking, it does work. It's a real concept, but just be wary of what product it is you're buying. Do your due diligence as a consumer. And then number two, it is something that you're going to have to maintain. So as a consumer, you're going to have skin in the game in the upkeep and maintaining, this investment. And then
And
two, just taking go ahead, well,
nah, I'll save it.
two, just taking a step back from like a financial planning perspective. So yes, the insurance at a baseline, understand that you are buying life insurance. So, most of the time you are going to want to have or should have some type of insurance need. So Will was saying it before, he has a family, he has children there. The people do depend on his income, right? So having life insurance at a minimum is important. The investment aspect is secondary because it is life insurance. So you do want to cover, number one, your insurance need, and then the investment, it does come secondary. It's just an added bonus that's there for you. And I know a lot of people in your community, right? You guys have done tons of certification. You guys bust your ass to get these jobs and to earn these incomes that you guys do have. So while your life and those that depend on your income is important, what I don't want you guys to overlook is like the other financial planning thing that you should be putting in place too. So I don't want to cloud too much, but short thing, ensuring your income or protecting your income. If your job doesn't provide you with short and long-term disability insurance, you do want to look into the marketplace for that as well. Your ability to generate an income is paramount to your financial picture. If you don't work, You can't pay bills. You can't fund your life insurance. You can't do all the things that you're accustomed to doing, upkeep with your lifestyle. So that's where disability insurance comes in as well. That's one of the legs in this foundation, like with the life insurance, equally, if not more important in the sense that you want to make sure that you're covering too. So just those two things, 100% on the concept of infinite banking. Just make sure that you're maintaining it, and that you know what you're doing. And then number two, we want to make sure that we are covering all bases. The ability to earn income is equally as important, as your life. So that's another important thing as well.
You said something earlier, and I wanted to give a real example. I just wanted to wait until you finish, but you said maintain it, right? Let's say you have a tree that is bearing fruit, right? You can't just, leave that tree or plant alone and then expect it to continue to bear fruit if you don't water it or maintain it, essentially, right? Um,
Exactly.
and so I had a real world example because, like I said, Kenny set these vehicles up for me and my family months ago. I mean, I think we're either a little,
Years, actually.
yeah, over,
I just saw
yeah.
your annual statement. You're going to be pleasantly surprised.
Oh, okay, great. Okay, I haven't checked, but that's great. But yeah, so it's been over a year and years at this point where
Yeah,
I set up the VUL, the IUL, the disability insurance, which I didn't even realize or understand why it was something that I needed. But I feel like I got this like metal suit over me, like I'm protected, and it feels
yeah,
really good. And every now and again, I did log into my statement, and I would see like my cash value growing. I see the death benefit there. It's like I know like God forbid, we don't plan for these, things to happen. And if you fail to plan, you plan to fail. So I just feel good knowing and sleep well at night knowing like if God forbid something happens to me, I've set my financials up in such a way where my family will benefit greatly.
yeah,
And they have that protection. That's wonderful. But I also get to see the living benefits, compound. And that's really exciting. The point I was going to make before I let you go back to what you're doing, Kenny, is at one point in the last couple months, I had a fluctuation in my income. I had a fluctuation in my take home pay. So what I ended up doing is initially we set up the policy, right? The death benefit, my premium, what I'm putting into my account, and I needed to adjust that. I needed to change it from what I initially set it up to reduce it so I can maintain my policy, keep it alive, right? That maintenance component, but just scale it back a little bit because my income changed to reflect what I was capable of in the interim. So
exactly.
that is a real life example of how I'm like, okay, I still know I got a life insurance policy I have to, fund every single month, but the initial investment or allocation that I initially set up, I couldn't no longer set up. I needed to change it. So all I had to do was pick up the phone and I can make a change to my policy so I can maintain my policy, keep it active, have my death benefit, my cash value, everything stays the same. All I'm doing is just altering, right, the allocation on the monthly. Now, let's say
Exactly.
2 months, 3 months goes down the road and my income goes back up again or it changes, right? I can always just make that another phone call and adjust that allocation accordingly. So it's really just a great vehicle. It requires, very little maintenance. There is maintenance, but very little maintenance. Just be
Hmm.
understanding, hey, you got to meet your premium. And if anything changes in your income, you can always scale it back, right? You can always reduce it to keep it active.
Exactly.
I believe that there's also a thing where you can like pause it essentially and still have your policy not, expire and whatnot. But
Exactly.
there's so many valuable things to having this policy, and so it's just, understanding the inner workings of it. But I just wanted to give
Yeah.
a little example, and that was pretty much it.
Yeah. 100%. And that's a good point we had left out as well. Like when it applied to the permanent policy, that the plan is flexible. So even though you're starting at, this premium, if something happens cash flow wise, or God forbid we lose a job, with this flexible policy, we have the ability to either reduce what the premium is or completely pause it. Not for forever, but for an indefinite period of time where we are maintaining it, but we have the ability to be flexible with it if something were to happen. So that's a great point that you bring up as well. Glad that you brought that up because we did mull over that. So yeah, I can show you guys an illustration of like a variable policy. So the one that Will had set up, and again, it's just like an illustrative example. All these numbers we're able to change. We can be as flexible with it, as we want. It's dependent upon like what ultimately the budget is and where you are. But for the example, and let me know if you see it, it should say VUL optimizer, equitable, and so
Yep.
on. All right, cool. So this is an example of a variable policy on a 32-year-old male who lives in New York. The death benefit is for $500,000. He's initially going to start out paying $457.43. And I should have used a round number, should have been like 500, but for this example, we just came up with this weird funky number. So the minimum that this person contribute we see here is $103. And then how I was saying before, how some policies have that no lapse guarantee. In order to keep that 20-year no lapse guarantee benefit, the minimum would be $350 monthly. So just two things there to note, but again, we are starting out paying the $457.43. So this, again, the illustration, it is kind of lengthy, so I'll kind of skip to the meat and potatoes, so to speak. Here we are. So this is showing like the yearly inputs and outputs of the policy. And again, it's a variable policy, so we are investing into the stock market. This column here shows us the 33-year-old male, the 547 that he's putting in monthly, or sorry, the 457 monthly, so the 5489 annually. And these three columns, I'll use a different color because this is blue. These three columns are showing us the different rates of returns. This column, we might as well exclude, we're probably not going to be doing 0% in the market, over an extended period of time. Yes, there'll be times where the market is either flat or negative, but for an extended period, we're not going to be flat. 4%, again, it's just an illustrative example. The market's likely going to do better. And even 8%, right? It's depending upon like how we invested, but if we are going to be aggressive, 8% is kind of like on the low end of what we'd be expecting. We'd more so want to be like on the cusp of like 10, 15 or so percent, like over an extended period. But this is going to show you on a baseline, right? Like if the market were either to do 0, 4, or 8% over these time periods, how the cash value would grow. So I illustrated this male, this 33-year-old male contributing that premium for the next 20 years, 5489, then he stops it. So over these 20 years, will have contributed almost 110,000. And I'll hyper focus on this column here, the 8%. We see after that period is up, after he contributes the 110, his money would have almost doubled. So he almost has 200,000 of policy cash value at that point in time. And although he started out with a $500,000 death benefit, whatever is accumulated in the policy's cash value is added on to the death benefit. So at this point in time, it's 500 plus the 200,000 of cash value, for a total of 700,000 of policy death benefit, right? Something to point out, because insurance, it's a long-term financial vehicle, a long-term contract, companies don't want you to be starting insurance, liquidating the insurance. Sometimes bad actors get into it for money laundering purposes and so on. So what they'll usually do is try to like disincentivize you from tapping into the cash value early. So in the early years, there's what's called like a surrender charge. So in year one, you put in 5489, you have 4,156 in policy account value, but your surrender value is 0. Again, the company doesn't want you to start it and liquidate it. So even though you have 4,000 in the policy, there's a surrender charge to keep you from liquidating this policy early. After 10 years is up, the surrender charge is over, and your policy account value is your net cash surrender value. So for whatever reason, if you needed to cancel the policy, you are able to access that full sum. There's no charge for liquidating it after that 10 years is up. But you can see, starting at, age 33, if you contribute for these next 20 years, you'll double your money or almost double your money, assuming this middle of the road 8% return. Then in your retirement years, you can see how the benefits of compounding interest, like over this time period, really start to, work to your benefit. Again, focusing on this 8% column here. At your age 65, you would have almost accumulated almost $500,000 of policy cash value. Your death benefit would have been almost $1 million. So at any point in time, right, if you need to access this money, you have the ability to loan from your policy's cash value. When you take money out via a loan, again, it depends upon which company you go with. For this example, I believe you can borrow for the first 10 years at a 1.5% interest rate. After the 10 years is up, you're borrowing at a wash or a 0% interest rate. So I'll just repeat that again. For the first
Yes,
10
please,
years,
please run that back because that is
yeah,
extremely important.
yeah. For the first 10 years, if you wanted to access your cash value via a loan, the loan interest rate would be like 1.5%. After the 10 years is up, after that surrender charge drops, you're loaning from the policy at a wash or use most of the time a 0% interest rate, right? So there's no charge to accessing your money, at a 0% interest rate. It's a great benefit to you. This is money you can use for an investment, right? If you want to do a real estate investment, if you need to send a child to school, you need to use access money for a tuition payment. This is money you can tap into to do that, float money that you're able to use that you can borrow from at a 0% interest rate or a 1.5% interest rate. And then you also have the ability to withdraw from the policy's cash value. So unlike a loan, a withdrawal is permanent. So it's money that you wouldn't be putting back into the policy, but it also permanently reduces what the death benefit is proportionally. So for example, in year 20, if we do a $100,000 loan and our policy at that point it's worth $687,000, our death benefit permanently is reduced from 687 to 587. Whereas if we do a loan, initially it drops to 587, but as you're contributing money back via the loan or you're paying back the loan, your death benefit automatically jumps back up.
So, a couple things to unpack, if I may. Within the first 10 years of your policy, you have some accumulated cash value and you want to borrow, let's say, Justin wants to buy his daughter her first car. And he wants to take, let's do what in year 10, how much is his accumulated cash value in this example? Let's just say in this example, just so we have real concrete numbers. So year 10, he has 58,000.
58,000.
58,000 accumulated cash value, and he wants to take 10K to purchase, let's say, a car for his daughter, right? Which I think that the timeline would probably be somewhat skewed a year or two based on, I think, how old your oldest is. But you want to buy
Yeah.
that car, right? Let's say, right, you want to buy a car. In the first 10 years, you can borrow against your cash value at 1% interest rate. Where in the world can you go right now, purchase a vehicle at 1% interest rate? What credit card can you charge at 1% interest rate? Because you can buy a car on a credit card. I've done it.
Yeah.
So there's that. Now, after year 10, you can borrow money at 0% interest rate because it's a wash. And I'll let Kenny explain how it's 0, but it's obviously the worst case scenario is 1%. Best case scenario is 0. But I want you to explain, Kenny, because it can get a little confusing if you've never done it.
Yeah.
When you borrow within that first 10 years at 1% interest rate, and let's say you're going to pay yourself back, is that money, while it's being borrowed, still being invested?
Yes, correct. The money that you borrow out of the money that you borrow out of the policy, like let's say it's 6,000 that you borrow out of the policy. 6,000 goes into a guaranteed interest account where it's going to earn interest, and then the interest rate that you're charged is directly deducted out of it. So in year 1 to 10, the math works out, and I'm trying to pull it out so we can use the real world numbers, but I believe it's 1.5 or so.
So while he's looking for that, essentially,
Yeah,
you can
here it
borrow
is.
in your policy, and while that money is being leveraged, it's going into another account, and you're still gaining interest on it while you're borrowing it.
Exactly. So here it
Where?
is. Here, this is the page where it talks about access to your money. All right, so we can do either a withdrawal, as I was saying before, which is permanent. And then here we have the ability to do policy loans. And then right here, this is what I was saying before. It's important, know what you're buying exactly, so we can point to it exactly where it's in the contract, right? So in policy years 1 to 10, there's a 2.5% interest rate charge. And then we know there's a guaranteed minimum annual loan interest rate credit of 1.5%. So in years 1 through 10, this works out to be a net 1% interest rate that you borrow from, or the loan spread, the difference between what you charge and then what's going to be credited to you. In years 11 and beyond, the loan interest rate charge drops from 2.5 to 1.5. Our spread, our credit still stays at 1.5. So that's what I was saying before about that wash, where it works out to be 0 that we're borrowing from after year 10. So accessing your money via loan, not paying any loan interest for it. This is where the infinite banking concept really comes from, where, yes, you have to build your policy cash value in those early years, but once you build that, chest up, you get real flexible with it. They give you a lot of benefits and creative ways that you're able to access it.
It's crazy. Shout out to Nipsey, man. It's called vertical integration, infinite banking. Your banks don't want you to know, your credit unions don't want you to know this because right now they're getting cut out the deal when you go and
Exactly.
turn yourself into a bank, because now you can tap into your own funds. And now let's just say, for the sake of conversation, Kenny, I want to take 10K, buy my daughter a car. I don't feel like paying myself back. Now what?
hmm So in the first 10 years, right, we saw that the charge was 2.5, the credit was 1.5, the charge netted out to be 1. If you never pay it back, it'll just continue to compound at that 1% interest rate. And then, at time of death, when and if you die, that outstanding loan, it's automatically deducted from the total death benefit. So, if we started at 500,000, we've contributed 100,000 after the first 20 years. And let's say at the point of life expectancy, age 85, or let's say age 90, right? We have, and that was my eraser. We have 1.8 million policy cash value, 2.3 million of policy death benefit. If at this point, let's say, for example, we have a $300,000 outstanding loan, at time of death, what would be paid out would be 2,074,000 and change to 257, because our total was 2.3 million. We had a 300,000 or so outstanding loan, so the loan subtracted from the death benefit, and then 2 million so is what's left as the net death benefit. So it's not that you have to pay the loan back. If you do want to pay the loan back, you want to put it back and allow the money to continue compounding. That's great, but you don't always have to pay the loan back.
That's incredible. So there's the some of the real, that's called the living benefits I was saying earlier that this vehicle, has that others don't. And so, you think about it, like if you have children, how could you not have a vehicle like this? Right? If you have children, how could you not have, most people, they may or may not have a, college savings account. I think it's called the 529 college savings account, right? That's
hmm
only specific use for college. And by the way, I don't know what college is going to look like in 10 years, 15 years from now, if you have younger kids with AI and what's happening in quantum, but that's a whole nother conversation. Um, but this is a vehicle where your kid turns 18 years old and they go and they buy their first multifamily property using the accumulated cash value in a policy that you set up when they were born or when they were a youth, and now when they're 18 years old, you're house shopping. Oh, by the way, it's what is it? Interest free. Oh, by the way, if you don't
Exactly.
want to pay yourself back, it just comes off the death benefit. Oh, by the way, when you're using the money, you're still gaining interest. And then when you pay yourself back, you're back to unlimited upside. This is a real financial vehicle that every single person, in my opinion, I'm not a financial advisor. I encourage everyone to speak to one. Oh, by the way, there's one on the call. His name's Kenny Charles. This is a vehicle that everybody should have. If you have children, if you have a family, this is how you own your time and you buy your time back. This is cyber literacy. Anyway, I just wanted to appreciate you giving that example, Kenny, because this is like,
Yeah.
that's where I'm headed with it. Is I can't wait to, I see that accumulation, and I'm sure we'll have another call to discuss how it's been performing. But I look at the cash flow, I'm like, wow, I'm excited. And then
Yeah.
one thing I'm sure you're going to cover this, but I just pointed out is there ever a point in time, right? If we're funding this, overfunding it, or just maxing it, is there ever a point in time in owning these policies where I can just stop paying and I never have to pay anymore, and it just keeps going? Is there ever a point in time where I can stop paying and not have to worry about the lapse in the cut policy, or just it'll pay for itself?
Absolutely. So for this example here, remember, like we ran it where we're only paying this premium, the 457 for 20 years, right? So this assumes we only do that 457. You know, this male is 33 years old. He's going to stop paying it when he's 52. After that, you know, he's built up 200,000 of policy cash value. This money is still invested in the stock market. So at this point, you know, as long as the market keeps returning, the policy is going to run on its own. He doesn't need to put a dollar into it if he doesn't want to. If he wants to, great. If he doesn't, it'll just continue to remain invested. The death benefit, you know, will continue to grow with the market and so on. So yeah, no, to Will's point, it's going to cover a lot of bases, right, guys? So you are building policies cash value. You can borrow at this money. You can borrow this money at a 0% interest rate after the first 10 years while you're living for any reason. There's no, you know, ifs, ands, or buts about it. You don't have to meet any 59.5 requirement like you would with a retirement account. Whatever you need the money for, you're able to access it. Nobody asks you anything about it. Another thing as well I mentioned, I mean, life insurance cash value is creditor protected. So for whatever reason, if you're sued, people can access this money. This is a protected asset. So while you're living, you're building up policy cash value, but again, you are building also a substantial death benefit for your family. I've been in
Hello.
the business for you know a little time now, so I've been on the other end of this where unfortunately I've had to deliver death claims for people that I've set these contracts up for. And I mean, you know, it brings tears to your eyes, but you're literally changing people's lives. I've you know delivered 4 death claims at this point. You know, many times I've sat with clients and understood truly what this money is going to be doing for them. So you know, this is how you change life, not only your life while you're living, but quite literally your family's life when you're not here anymore. So again, you know, it is life insurance, but there are living benefits that you're able to enjoy as well.
It's crazy. Justin, any question? I know it's a lot, and I remember when I had this first conversation with Kenny, I was just like, "What?" Like, I kind of felt like it was a point where I was just like, "Why have I not known about this?" Because I'm thinking like, yo, if I would have started, I tell my sister, right, if I'd have started this when I was 18 or 20, like, you know, it's like,
Yeah.
and it's just crazy. Like the money that you have access to at your fingertips, tax free, interest free. That's like for a car, a house, whatever reason. Like right
Hmm.
now, if I want to go purchase something that because I have my policies, I could tap into it. I won't right now. But other than that, right, my other option is I would have to go charge a credit card, go take out a personal loan, which I've done both, right? I've taken out a personal loan, I've charged a credit card, right? What options do you have, right, when you're, working with just standard investment vehicles or just, regular capital, right? So I think that that's like a differentiator and just a game changer. Um, there's so many unique components to this vehicle that I
Yeah.
just think everybody should, really take advantage of the benefits. So, and you're muted, just I think at one point I had to mute you just for there was an issue with the mics. But any questions, comments, need clarity on? Kenny can answer.
At this time, no. It's a lot of information, but overall, it sounds like what it does provide is almost like you said, like that shield of armor. So if stuff hits the fan, if stuff goes left, whether if it's in your job, your life, there's always some type of blanket of comfort of, hey, you got this vested. Hey, you have this available. Hey, you can go grab that and hold you down for these couple of months and then put yourself back once you're good again. That's what I'm grabbing from it the most. Like, okay, I've been in both positions, not necessarily the income I'm getting right now, but in a position where I felt comfortable making a decent living and flowing with it, and then it went away, and now it's kind of coming back. So for me, that's providing the comfort in between, with also at some point allowing me to do a little bit more with it once I learn more, once I'm able to put some time into it. So I'm intrigued. I'm intrigued. I won't act like I don't want another phone call. I definitely would like to have another call and talk more in depth about this, but I'm intrigued. I'm definitely
Of
intrigued.
course. I appreciate that. And yeah, I know it's a lot to wrap your head around. So yeah, I do encourage like to definitely we'll hook up after we can have a meeting and go over you know, a more specific example that applies to you personally. Again, this was just, you know, for illustrative purposes, but this tool could work for anybody. We can have somebody who has $100,000 death benefit or $1,000,000 death benefit, but the basics or the mechanics still work the same. There's still
Gotcha.
policy cash value. There's still a death benefit that's going to be there. So there's a shoe size for everybody, so to speak.
And Kenny,
Copy that.
is this my screenshot of
Yeah,
my
yeah.
performance?
hmm
Oh man, wow. Okay. We'll have to talk about it. But yo, it's crazy because I have a similar policy, and I'm okay with speaking about this just because I'm so passionate about financial literacy, or what we're gonna start calling and branding cyber literacy. Okay, you heard it here first. Um, and I have a couple policies similar to the one we just looked at. And my allocation was a couple $100, and I remember my fluctuation changed, and I changed it to, I think mine was like $150 or whatever I changed it to. In that example, I think it was 457, and the minimum that you can put to keep the policy active, and if you're not completely pausing it for a definite period of time, for a finite period of time, was like $103. However, if right, whoever, let's say just in this example, he could obviously overfund it if he wanted to put more than 457 and pay like 600 or 750 a month, whatever he was comfortable allocating, and then shorten that window of like how soon it's completely funded. Like initially it was 20 years at 457, but let's say he put double and put 800 or whatever, he could essentially
Exactly.
shorten that timeline where like the policy can be fully funded in 10 or 12 or 15 years, give or take. Let's just say.
Exactly. So
So
in that policy example specifically, I mean, to your point, we only illustrated contributing $457, but you know, to just so you know, the maximum or the ceiling on what he could have contributed to the policy is like $2,400 on a monthly basis. So there's a huge, you know, threshold of both where you could bring it down when things aren't as great, you need to pause it or whatever the case is. But again, if you want to shorten that time period up, if you don't want to contribute for 20 years, you want to contribute for 10 years, you know, there's a huge threshold on the upside as well, where you're contributing for 57, but if you want to, you can put all the way up to like $2,400 monthly into the policy if you wanted to. And obviously, if you do that, your timeline or your time period that you're going to be funding it for will move from 20, you know, down to maybe 10 or maybe like 7. But there's a huge like window in terms of like what you're able to contribute. One thing I want to throw on there, well, I don't want to keep everybody too long, but we talked about life, we talked about disability. I do like to bring everything together when we're doing like financial planning with individuals who aren't as comfortable doing everything on their own. So for those people, like there's a tool that I use, an asset map or like an aggregator tool where it lists like all your different individual assets, your income, your 401k, your disability insurances and such. So you're able to see something, and this is the page here. You guys can see it.
yep.
So this is the asset map mixed Scrooge household. So just a example that I did. So you see like a sample couple that's in the middle, Scrooge McDuck and Daisy. On the left, we see Scrooge's income. So he's a banker, and then he has a inherited property in real estate, inherited rental in Buffalo. He's got a 401k, got an inherited IRA, got a Roth, a brokerage, student loans. The McDucks have joint assets, joint 401k, joint checkings, real estate, and so on. Daisy's income, Daisy's retirement. The insurance is on top. So we see term, whole life, disability. So a real clear picture of everything where we can see things clearly and have, concise conversation about the assets and where they are and what the plans are. But in these individual assets, we're accounting for taxes, contributions, expected rates of returns, many different variables that come into play. So we can have a conversation about different goals. So we can plan for educational funding, retirement funding, what happens in the event of a loss of life. Not that this is like an end all be all, but to give you a firmer understanding of where you are. So if I contribute, this amount to my 401k, this amount to my life insurance, this amount to my Roth, fast forward 15 years out, what could potentially be the outcome? Where may I end up? This is a way for you. I know, sometimes our employer will give us like a 401k tool where you can hyper focus and see kind of like how that'll do over time. But what this is going to do, this is going to be more comprehensive in a sense that it'll take into account not just the 401k, but everything that you have going on, banking, insurance, retirement, real estate, to give you that clear, concise picture. So this is something that I do, big picture when we're talking about financial planning. If we have children that we want to plan for, a retirement, and so on, this is where I would start as like a foundation for clients. But that's all I have for you guys. Will, I appreciate you. I appreciate the opportunity. Justin, thank you um, for staying locked in and everything. I look forward to the opportunity of working with you and getting you started as well. And Will, I know you're going to be happy to go over the numbers and everything. So looking forward to that.
Real deal, Kenny Charles. My guy, man. Thank you so much. This was absolutely wonderful. Just I appreciate you, tapping in, sharing, your story. And I know this is great. Listen, at the end of the day, like people are looking to change their lives, and cybersecurity is the answer, right? Is a vehicle. And it's our responsibility, specifically as parents, husbands, wives, like it's our responsibility to take control of our finances. And I think this is one of the best ways to do it. While ensuring the death benefit when we depart, which is what that's attributing towards generational wealth. People talk about the generational wealth thing, but nobody actually wants to be the person who takes the initiative to actually achieve financial wealth. If imagine, and just we know each other personally. Imagine, losing a loved one, and you know, it's a little bit more. Um, it's easier when the foundation was correctly laid, so that because it costs money to depart. People don't even
Yeah,
talk about it. It costs money to depart this earth.
yeah,
It's not free to breathe air, but you can't even leave without leaving a bill.
yeah,
It costs money to depart. So that's a whole nother conversation because there's a policy for that. But
yeah,
the point is, imagine like you experience that, and it hits different when somebody took the initiative to make sure, yo, before I got up out of here, you know, I made sure that y'all were taken care of. That's
yeah,
real sacrifice. That's real generational wealth. No, and somebody's got to do it. Somebody's got to take that initiative. And so you, Justin, being in this position where you're about to make money, that life-changing money that you've never seen before, right? And so being in this opportunity to embed this financial vehicle, because you're going to be seeing money you've never seen. So even if you were to embed this financial vehicle, you're still going to be seeing more money with that allocation, because there's going to be so much more meat on the bone that you're not even used to getting. So this is the perfect time. And I'm not a financial advisor. Highly encourage you to speak to one. Oh, stat, there's one on this call. So the point is, that's where people's focus should be. Once they get the money, what to do with it is a whole nother conversation. And you should embed these best practices early, because the worst thing you could do is get used to and acclimated to this new lifestyle. Now you're going out to eat a couple times, you know what I'm
yeah,
saying? T-bone steak instead of the, what I'm saying, the strip. It's just, you know what I mean? And now you're getting comfortable. So now later on, 6 months from now, 12 months from now, you're accustomed to seeing that number in your account. So now that allocation might feel a little different, because you're like, where is it going? Even though it's still going in an account that you own, and it's still getting interest more than it is in your savings account where the money is going initially. So it's just a mindset. It's an educational mindset shift. Most people, financial literacy. But yeah, man, this is an opportunity that everybody has access to. And to be honest, you don't need to make six figures to implement this strategy. You could
no,
be
yeah,
making 50,000 working at Walmart, and you can have this type of vehicle working for you on the back end, because it's
yeah,
mindset. If there's no, you got to make an X amount of money or be in a certain profession. You could be a bartender. You could be a barber. You could be a garbage man. You could work a halal truck, and you can have one of these policies, because it's
yeah,
financial literacy and investment strategy, not you got to make a certain amount. So, man, this was incredible. Kenny, this was incredible.
yeah,
Justin, appreciate you. Again, you guys will have information. Like, you guys can get on another call and actually go through the hard coded numbers. I know you're starting your job tomorrow, Justin. So that's exciting. I mean, wow, that's super exciting. And so this is the best time. So you guys will wrap one on one. And for anybody watching this video, if you're lucky enough to experience the success of Justin, and you've secured that bag, you've secured your future in cyberspace, make sure you apply best practices. Make sure you concatenate the cybersecurity skills and income and resources with a financial literacy investment strategy. And that's what we're talking about here, cyber literacy. And reaching out to Kenny Charles would be your best bet. It's a really good brother of mine. He made it happen for me and my family. I'm sure he's gonna make it happen for you, Just. And yeah, the world is yours, y'all. So
Appreciate you guys. Well, thank you.
Thank you, guys.
got it.